Hello friends, welcome to learning sessions, and in today's RAROC is risk adjusted return on capital. It basically take care or accounts for the different types of the risks which may be associated with the investment. So if you're getting higher RAROC, it means even if the risks are there, even then you're getting this adjusted return over the particular investment, right? So as I told you, there are two investment, INV1 and the second investment INV2. In INV1 you are having 6.5% of the RAROC. In INV2 you are having 8% of the RAROC. Which one will be preferred? Definitely the higher one is to be preferred. We have to go for the higher one RAROC, right? So if you want to get the PDF of this particular file, you can simply be WhatsApping CAIIB updates, and you need to WhatsApp on the number 83609 44207, right? Now let's move further and learn the other concept. Now there is a three-way linkage. Now the linkage was more is the risk, more is the capital required so as to absorb the risk, and more is the return that you can be getting, because more is the risk, you will be taking much more risk in basically in point to get the more return, right? That's the case. Further, it's related to the basic risk management framework. Let's have a look at the basic risk management framework, right? Now when we're talking about the basic things, it means that what things should be taken into account for designing the risk management framework, right? So first of all, the top management is having the much more major concern related to the management of the risk over there, right? They should be looking into it. So four fundamental considerations are there which should be taken into account. First one, it's related to the top management ownership, that the risk management is a concern of whom? It is a concern of the top management. So when you are basically lending in bank, whatsoever the risk you are taking, it's not your cup of tea, na? It's the top management that who will be looking into it, that what things are to be implemented so as to manage the risk, so as to basically manage the policies. So that basically point is related with the top management, right? And the second most important thing is related to the identification and the quantification. Identification is very much required, because only when you will be identifying the risks, only then you can be quantifying the risk, and only then you will be trying to mitigate the risk. That part is clear. So we cannot be quantifying the risk directly. First of all, we are to identify the risk. So one, it's related to identify. Second, it's related to quantify. And after that, you try to mitigate that particular risk. That is basically related to the identification and the quantification. And after that, the third one, it's related to risk-based pricing. Very much important. Now, if we consider the case that, let's say case, your bank is lending for the housing loans at 7.8%, let's say, right? And your bank is lending for the credit cards at whopping interest rate of 36%. Why the bank is lending for the credit cards at 36%, whereas in the case of the housing loan, the bank is just lending around 8%? Why it is the case? Why the bank is lending at a huge differences? There is a simple thing, because much more risk is associated with the credit card portfolio, right? Definitely the much more risk is associated with the card portfolio, and the bank would be like bank will be structuring the things in such a manner that the bank is getting higher returns on the credit card so as to cover the losses associated with the same, right? Whereas in the case of housing loan portfolio, the bank is having lesser risks, right? So bank is basically charging very lesser, right? So that's a scenario related to risk-based pricing. So you price the risks according to the contentment of the risk associated with that particular asset or investment, right? Further, there should be a dedicated setup. Now what does this mean? There should be a dedicated setup. Now risk management, if you want to manage the risk management, that particularly requires specialized skill. You do require specialized skills for the same. You must be having a separate setup in the organization which will be having the objective so as to manage that particular risk over there. So these are the four things, four framework pillars we can say, which are to be taken care of. Is that clear? Now after that, it's related to the organization of the management. or organization for the risk management, we can simply say. So we are having the board of directors, RMC at the board level, that is risk management committee at the board level, committee of the senior level executives, and the risk management support group is there. And the overall responsibility remains with whom? That always and always remains with the board of directors. So whatsoever the policies, procedures, aggregate risk limits, review mechanisms, or let's say reporting audit systems which are to be articulated, that articulation, only articulation I'm talking about, that articulation is being done by the board of directors, right? So board of directors will be deciding the risk management policy and will be deciding the limits for the various types of the risks, right? So whatsoever the limits which are set upon, those are set upon by the board of directors. Whatsoever the policies or procedures are to be taken care of, those policies, procedures are also being set up by the board of directors, right? Those are being set up by the board of directors. Is that clear? Further, the second tier, we are having the risk management committee. Now, risk management committee is a board level subcommittee. It is a board level subcommittee, right? And the major responsibilities are related to what? That what's the guidelines? Now, whatsoever the guidelines are there for the reporting purposes, for the risk management purposes, that must be taken care by the risk management, and the risk management committees to take care that whether we are basically conforming with the policy or not. The risk management committee is to make sure, that is to ensure that the policy is being conformed with. That's not only in the paper, right? And we are also following that particular policy. That's the job lies with the risk management committee, which is a board level subcommittee, right? Further, whatsoever the prudential limits are being set up, their periodical reviews being done, whatsoever the models are there, so as to check the robustness of those models, and proper manpower is available or not, those tasks lie with the risk management committee. So when we are talking about the confirmation, that we are conforming with those particular policies related to the manpower, proper appropriate manpower is available with it, so as to basically review the prudential limits, right? Those all tasks does lie with the risk management committee, which is a board level subcommittee. After that, we are having the senior executive committee. Now, senior executive committee is responsible for the implementation, for execution, that we are to manage the business policies, we are to basically implement the risk policies simultaneously in such a manner that we are conforming with the business strategies, and so as to keep in mind also that we need to achieve the objectives also. Those are to see, the senior level executives are there because they basically, we want to what, that we want to manage the risk also, we want to implement the policies also, and on the same side, we are to reach the or implement the objectives also. Whatsoever the objectives are there, organization objectives are there, those are also to be taken care of, right? And the fourth one, it's related to the risk management support group. Now, support group analyzes the things. It works on the ground level, right? It works on the ground level. So monitoring, reporting, analyzing, these things are being done and being reported to the senior level executives. So they do report to the senior level executives, and they are basically implementing the monitoring function, measurement function, analysis function, reporting function, though that is being done by the risk management support group. So four tier function is there. One, we are having the board of directors, which are having the overall responsibility. Second one, it's related to the risk management committee, which will be conforming the things. Manpower is being provided by the same, robustness of the models being checked. And the third one, it's related to the senior level committee, which will be basically responsible for implementing those policies and so as to achieve the objectives. And the fourth one, it will be working independently so as to monitor, measure, analyzing and reporting the particular risk to the senior executives, right? That's the case. Is that clear? So we have already covered those all points related to it. You can further go for them independently. Now let's have a look at the risk management process for the risk management. Let's have a look at it. So first of all, it's related to risk identification. I simply told you that the first step is always and always related to risk identification. Once you have identified the risk, only after that you will be quantifying the risk. Once you have quantified the risk, you will be pricing it accordingly, and you will be trying to monitor the risk, and further you will be trying to mitigate the risk. So this is a chain of cycle that we need to follow. We can only be learning only when we'll be looking into the fact that how it does work. So first of all, we need to identify the risk. The risks first of all must be identified. So that is a first step. So whatsoever the transactions which are being undertaken, those must be having a single risk, or maybe having a group of risks. Multiple risks can be there. It could be the liquidity risk, interest rate risk, market risk, default risk, operational risk. Any of the risks can be there, and all these risks which are basically contracted at the transactional level, like certain risks are basically which are available at the transactional level. Let's say when you're lending to an individual, ABC Bank lent the amount to an individual. Now, definitely, when the bank lent to an individual, it could be related that the credit risk is there, default risk is there. It could be related that the person has prepaid the amount, right? That risk is there. It could be the case that there is a default in the repayment. Repayment means timely repayment was not there, right? So time risk can also be there, right? And further, it could be related to different types of risks. So the risks can be at the transactional level, or it can be at the portfolio level itself. Portfolio level means when your interest rate is changed particularly, or when we are not talking about the transactional level, when we are talking about at a bunch of loans, right, at a bank, whole bank level, that is a portfolio level we are talking about, right? So the risks can be manifesting at the individual level, that is a transactional level, and those could be there at the portfolio level also, right? So the major category of risks are what? These are the liquidity risk, interest rate risk, market risk, credit risk, and operational risk, right? And further, even more than that. So liquidity risk is to be managed at aggregate or portfolio level. Interest rate is to be managed at the portfolio level. Market risk is to be managed at the portfolio level, right? But the credit risk is a type which is to be managed at the portfolio level as well as the transactional level. Operational risk is to be managed at the portfolio level as well as the transactional level, right? So there is a difference related to it. One risk is available at the portfolio level, the other risk is available at the transactional level, and also it may be available at the both of the levels, right? Is that clear? Now, let's have a look at this particular example, and let's learn this through a image over here. Let's learn this through an image, right? So there is a simple scenario. I'll be trying to explain the scenario to you. Let's say the case that the branch B is there. There is a one bank, and we are saying it is a branch B, right? Who has extended a loan of rupees 1 crore in accordance with the corporate policy. So you have basically extended a loan of rupees 1 crore, right? Rupees 1 crore loan is being extended as per the corporate policy, and this is extended for a period of 5 years, right? So this is extended for a period of the 5 years at the rate of interest of 1% over the BPLR, and we are considering the BPLR right now is 10%, right? BPLR is base prime lending rate, and previously it was being used. Right now it's being MCLR, marginal cost of lending rate, or it could be even the uh, external benchmark lending rate could be there, right? So let's say case that the BPLR that we need to consider, it is 10%, and whatsoever the loan is being given, it is given at rate of BPLR plus 1%. It is clearly said over here, right, that it is extended at a rate of BPLR plus 1%, right? Further, the loan is to be repaid in equal quarterly installments. The loan which is being given, it is to be repaid in equal quarterly installments with 1 year of the moratorium. So 1 year moratorium is there. Like in the first year, no loan repayment will be done, and the loan repayment will be done in the second, third, fourth, and fifth year, and quarterly installments will be there. And the loan is actually funded from the deposit of 3 years of the same amount. So we were having a deposit of rupees 1 crore which is available there for 3 years. So it means the deposit will be getting matured after 3 years of the period, and further it is the interest rate the bank is to pay is 6% on this particular deposit. Is that clear? Now, what are the different type of risks which may be associated with this particular transaction, right? So you now understand that what transaction is there, and we are not to consider the CRR or the SLR requirements, but we need to tell that what different type of risks which may be associated with this particular transaction. Is that clear? Is the problem statement clear to you? So let us now discuss that what type of risks will be there. The first risk that we are going to discuss is the funding risk. It is a funding risk which will be associated. Why the funding risk will be there? Now, let me just tell you first of all about the funding risk. Funding risk is that risk that when we need to replace the net cash outflows, we have to replace the net cash outflows. So here is a scenario. Let me just draw the timeline for it. Let me just draw the timeline here so that you can understand. So here is a scenario. We are having the year 1, 2, 3, 4, 5, right? And here is a scenario for the deposit 1, 2, and 3, right? So for the loan, it was given amount 1 crore. Here also the amount involved is rupees 1 crore deposit, which is with the bank. And on deposit, the bank is paying 6%, and on the loan, bank is receiving BPLR plus 1%, and BPLR being 10% for now. So we can say effective rate of interest for now is 11%, right? So that is the case. And there is moratorium for the first year, no repayment will be done, and the repayment will be starting from the second year, right? And for in the by the end of the third year, the half loan will be repaid. The half loan will be repaid because it will be dividing at the end of the third year, it will be dividing into total equal parts. So if we consider that there was no default, we can simply say that 50% of the amount must have been repaid. It must have been repaid in general scenario, we can say. And here the scenario is that after 3 years, the amount will be paid to the customer. So here is what, that 1 crore amount is being paid, but the bank has already lent the amount to the customer. Here the amount is already lent, so we need to replace these net cash outflows. So whatsoever the amount which is to be paid back to the depositors, that is to be taken care of, right? We are to basically replace those cash outflows, net cash outflows. That is what, that is a funding risk. That is a funding risk, right? So the funding risk definitely will be there because by the end of the third year, 3 years, the loan amount will be repaid to the extent of 50% only, but still 50% amount is to be paid back, right? That's the first risk. And the second one, it's related to the time risk. Now, why time risk over there? Because it could be the case. Now, in the first scenario, we considered that the 50 lakh amount is already available with the bank that has been repaid by the borrower, right? But 50 lakh amount is to be taken care of, right? That was the case. But in the second scenario, we can be considering, because risk is all about the possibilities, adverse possibilities, right? And if we do consider that there was some default by the borrower, like non-repayment was there, in that particular scenario, it may even be the case that the more outstanding amount may be more than rupees 50 lakh. Let's say the case that the borrower has not paid the last 2 quarterly installments, then definitely much more amount will be outstanding over there. So that is what, that is a time risk. That is a time risk. And further, the third risk, it could be related to the basis risk. It could be related to the basis risk. Why basis risk? Now, basis risk is something where the bases are different. Basis on which the interest rate is being calculated on the assets and the liabilities are different. In the case of the asset, that is in the case of the loan is being given at the BPLR, that is a base prime lending rate. The loan is being given, and when the BPLR will be changing, definitely your net interest margin will be changing also. Let me just make you understand this concept. Let's first of all consider the scenario that you are receiving an interest rate of 11% on the loan, and you are paying a rate of interest of 6% to the depositor. So the net interest income, that is NII, for the bank will be 5%. Clear? That will be 5% for the bank. And in the second scenario, let's consider that the BPLR is now reduced to 9%. Previously, we considered that the BPLR is 10%. We were having a interest income effectively 11%. But now we are considering that the rate of interest is reduced. Now, once the rate of interest of BPLR is reduced, your overall effective income reduced from 11% to 10%. Now, in the next thing, we are having the BPLR 10%, but on the fixed deposit, we are paying a fixed interest rate of 6%. So our NII now reduced from 5% to 4% because of the different basis of the interest being paid on the asset as well as on the liabilities. Clear? Right? So definitely the basis risk is also associated with it. So we can simply be saying that the basis risk is associated with here, right? So that was the second, that was the third. We can say risk which is associated majorly. Told you very clearly that in the case of the risk management, first of all, it's related to risk identification. Then we do quantify the risk. Then the risk pricing is being done, monitoring is being done, and further we can do the mitigation part. But further, I also told you whenever we try to mitigate the risk, definitely somehow we also do lose the potential, positive potential. Let's take the case that if I want to safeguard my car from getting lost, or let's say if I want to basically get the insurance cover, for that particular case I'm also to pay the premium, and when I'll be going to pay the premium, definitely there is some cost that has occurred to me, right? In the same scenario, let's take the case that the ABC bank is there, that is going to give a loan exposure amounting rupees 10 crore to XYZ company, right? But now ABC bank is in doubt that further it may happen that due to any of the defaults or due to any of the instances, it may be the case that the amount will be defaulted by person XYZ or XYZ company over here. Now in that scenario, ABC bank, which is going to be the protection buyer, will be going to the protection seller and is going to buy the protection that in any of the events, CDS, that will be credit default swap will be done, that if there is any default in that scenario, the loss will be made good by the protection seller, right? For that particular scenario, the ABC is to pay a premium to the protection seller. So ABC is a protection buyer and PS is a protection seller, and the bank is to pay some amount as a premium to the protection seller so as to get some protection. So let's say previously the bank was making 1.10 crore as a revenue from that particular 10 crore loan, but now as of the premium is to pay, let's say 10 lakh premium is paid, in that scenario the bank will be earning only 1 crore. Now the positive potential is also reduced whenever we try to reduce the negative potential or downside potential, right? So we covered about it, the risk identification, the major risk categories we covered a case study even, right? So if you are going to clear the CAIIB, if you're having a resolution so that you want to clear the CAIIB in the first attempt, this is going to be a very good opportunity for you, right? And now let's move further. We are going to cover the three categories of the risk management. Now, what are the three categories of the risk management? First one, it's related to, we are having the sensitivity based, and identification can be done on sensitivity based. Second one, it's related to the based on the volatility, and further the third, quantitative measure where the risk can be classified, it is the based on downside potential. So first of all, we are going to cover the sensitivity, that is the sensitivity measure. So sensitivity actually does what? Sensitivity captures a deviation of a target variable due to unit movement of a single market parameter. As I told you previously also, there are multiple parameters which do affect the movement of the particular loan amount, or let's say we can say the underlying exposure whatsoever you're having depends upon a number of parameters. And let's the case, I'm just taking one single parameter, I'm not considering any other parameter, and I'm going to do the unit movement of this particular parameter, and then I'm going to check the changes in my exposure. That is what? That is a sensitivity. Let's take the case that I'll be looking into the factor of the interest rate only, that when one unit movement of the interest rate is being changed, right, in that particular scenario, what is going to happen, how it is going to react, that is what? That is a sensitivity, right? So that is the case related to it. But sensitivity is having its limitation. One limitation I already told you, because in case of sensitivity sensitivity, you do go check only one single parameter. You don't go and check multiple parameters. And in real life practical scenario, there is multiple role play that the multiple parameters do act simultaneously. So this is a very big you can say drawback related to the sensitivity. And moreover, sensitivities do depend upon the prevailing conditions, and definitely they are going to change as the market environment is going to change. So it's not going to help you. It's just for the, let's say, we can say book purposes, that you can say that if 1% interest rate is changed, then what's going to happen, how much change there will be in the underlying particular exposure over there. That's the sensitivity. And after that, the second quantitative measure is the volatility. Now volatility is basically related to the stability or instability of the random variable. Let's say the case that we are having a random variable r, right? So whensoever we are going to change something, right, or let's say case we are measuring the particular exposure at different instances, it's basically having the different values. Now this random variable is changing the values like r1, r2, r3, r4, and up to rn it is changing the values. Now at the different time instances it is having the different values, right? And let's say case I found the average of this random variable r. Now what will be the average? It will be the sum of all the terms, that is r1, r2 plus r3 and up to rn over here, and divided by the number of terms. Let's basically denote this average by the letter ra. Now what's going to happen actually, that if we draw a particular graph related to it, and here comes the RA. So average will be lying somewhere here, and the different points will be lying. Some points will be on the left side and some points will be on the right side of the average. So we can say that some of the points might be favorable and the sum of the points might not be favorable, right? That may be the condition. And when I'll be drawing a graph related to it, you'll be getting a bell type structure. This is called distribution. This is called what? This is called the distribution. And if the graph is symmetrical around the curve, it is said to be the normal distribution. Right now I'm not concerned about if the distribution is normal or not normal. I'm just telling you one thing, that we are going for one single random variable and we are checking its value around the particular different point of times. And if we basically have a common statistical measure, then it will be showcasing some dispersion around the average value. So RA over here is representing the average value, and these particular points are showcasing the dispersion because these values are somewhat different. Let's say case the average was 800. Now the some values might be below 800 and some values might be above 800. And when I drew the graph, it is coming somewhat like the bell type structure. This is what this is related to the dispersion. Now this random variable could be earning, it could be related to market values, it could be related to the losses due to default, it could be anything, right? So volatility is telling you about the changes, it is telling you about the certainty and the uncertainty, and volatility is none other than the standard deviation. So we can simply be saying that when we are talking about the volatility, it means we are going to talk about the standard deviation. Is that clear so far? So standard deviation tells you about the changes, it tells you about the thing. And in the last particular video, I told you very clearly that the volatility is the standard deviation, and more is the volatility showcases more is the risk there, more is a inherent risk to it, right? That's the main thing. And what do you mean by standard deviation? Standard deviation is the under root of the variance. So standard deviation is none other than under root of the variance, and we can easily be calculating the standard deviation. The formula is quite simple. Like in this particular scenario, if I tell you we are having the average as RA and I'm having the different terms like R1, R2, R3 up to Rn. So if I am to calculate the standard deviation, how can I be easily be calculating? It's the sum differences from the average mean, right? So it will be R1 minus R bar square of the same plus R2 minus R bar and square of the same, and so on up to Rn minus R bar or Ra square of the same, right? And divided by the number of terms. This is the formula. Let me just tell you the point over here. This is the formula related to the variance. So this is related to variance, and when I'll be finding the under root of the same, it will be the standard deviation. We'll also be solving the standard deviation, so don't worry, you'll get to know that how we can be solving the standard deviation so far. Is that clear? Kindly please do let me know, kindly confirm the same, right? So that's the first point related to it. And volatility calculation is having a simple formula over the time horizon. So if we are to calculate the volatility over the time horizon, it is daily volatility multiplied by under root of the time, or under root of the time horizon. We'll be solving a case study based upon it in the next video. We will be solving a case study based upon the volatility in the next video. Don't worry about the same. Now let's have a look at this particular question. So we are having the different particular zones, or different 5 zones, A, B, C, D, E. These are 5 different zones here, and for the different years we are having the different operating profits. Like in year for A we are having 11, 9, 3, 12, 11. And when we are going to find the average, this is mean is showcasing average, right? So average is having the formula related to what? That sum of the all the terms, that is 11 plus 9 plus 3 plus 12 plus 11 divided by number of years, that is 5. So it is 9.2. 9.2. This is the average. And how we can be calculating the standard deviation? How we can calculate the standard deviation? For first zone, let me just calculate the standard deviation for you so that you can understand the point, right? So first of all, we are having the average with us. It is 9.2. So the formula goes like, standard deviation is having the formula like x minus x bar square of the same divided by number of terms, and that's it. This is the formula. Now how we are going to calculate? The first term over here is 11. So 11 minus 9.2 and square of the same, plus 9 minus 9.2 and square of the same. Because it is square, no term will be negative, right? Other one, it is 3 minus 9.2 and square of the same, plus 12 minus 9.2 and square of the same, plus 11 minus 9.2 and square of the same. These are the 5 terms, and divided by number of terms, that is 5, and under root of it. So this is what we need to solve. Very much easier, don't worry. So it is 11 minus 9.2 and it is 1.8 multiplied by 1.8. So it is 3.24. The first term will be 3.24 plus 9 minus 9.2, that is 0.2. 0.2 multiplied by 0.2, that is 0.04. So it is 0.04. The next one is 3 minus 9.2, or 9.2 minus 3, that is equivalent to 6.2 multiplied by 6.2, that is 38.44. 38.44. Next one is 12 minus 9.2, that is equal to 2.8 multiplied by 2.8, that is 7.84. The last term is same as that of the first term, that is 3.24. 3.24 and divided by the number of terms, that is 5, and under root of it. So we will be adding up all the terms. So it will be 3.24 plus 0.04 plus 38.44 plus 7.84 plus 3.24 and divided by 5 and under root of the same, that is 3.24. So it is 3.2496. This is the standard deviation. This is a standard deviation. And let me just tell you one more point. Whenever we are going to check one single particular zone or one particular, let's say, industry or something, then we are to find the standard deviation. We can be telling you that which one is more volatile or which one is carrying more risk, right? But when we are talking about the multiple zones and we are to compare them, inter comparison is to be done. In that scenario, we are to calculate the last particular term. Last term is to be calculated. In that scenario, last term is to be calculated. So it will be 3.2496 divided by 9.2, that is equal to 0.35. So we have to calculate standard deviation to mean ratio. Standard deviation here we calculated 3.2496 divided by the mean, that is 9.2, and it came out to be 0.35 over here. Right? So for all the zones, we calculated the same way. We calculated the mean, we calculated the standard deviation, we calculated the standard deviation to mean. So in the question, they can simply be asking you, like in the case study type question, it can be given to you that you're just provided with the number of years and the zones over here, and you have to calculate the means yourself. You have to calculate the standard deviation, and you have to calculate the standard deviation to mean. It won't take you much time if you are practicing over it, right? So just make sure that you're having the simple calculator with you whenever we are online, when we are live, when we are solving it, and whenever you are studying, you must be having the simple calculator along with you, right? So you can check that we are having the different values. Here we are having 0.35, 0.63, and so on. Now, in what particular case you are having the least value? In which case you are having the least value? In the case of zone A, we are having the least value. Least value showcases what? That the least volatility is there. And whenever least volatility is there, it means the least risk will be involved in that scenario. The least risk will be involved in that particular scenario. Is that clear? Is this clear so far? Kindly please confirm. So we are having the least risk in case of which zone? It is the zone A. It is a zone A where we are having the least risk, and we are having the maximum risk in case of which zone? We are having the maximum risk in case of zone B. Maximum risk, we can say, in case of zone B. Now, the interesting point is that is the role of diversification. Now, what do you mean by diversification? Let's take the case that you have invested the money in equity. I'm just giving an example here. Let's take the case that you have invested the money in equity and your ROI is, let's say, 13%. But definitely it will be carrying much more risk. Now you are investing some amount in the SIP. You're investing some amount in FDRs. You're investing some amount in mutual funds, right? Now, different instruments will be carrying different risks. Some of them will be having the higher risk and some of them may be having the lower risk. Let's say case ROI we are considering for SIP, let's consider ROI is 10%, FDR it is 6%, mutual fund it is 8%, and that's the case, right? Now, what will be the average? Average would be definitely be lesser than the higher one. Now, if you have to calculate the average, it will be 13 in plus 10 plus 6 plus 8 divided by 4. That is 9.25. So in this scenario, you are earning an average ROI of 9.25%. So this is what I'm trying to tell you is that whenever we do diversify our portfolio, the overall risks can be reduced. The overall volatility can be reduced. And that is quite visible from this example here, that the overall standard deviation to mean may be higher. It is even 0.63 in one case, 0.44, 0.49, 0.36, right? But when we are doing the diversification for different portfolios, different zones over here, the overall standard deviation to mean value is very much lesser. So companies and banks do try diversification whenever they are to reduce the overall risk. So whenever we are to reduce the overall risk, we can do play along with the diversification, right? So that will be all related to this video. I hope that you must have understood the concepts, and tomorrow we will be covering very good numerical for the forex exchange. Make sure to like this video, and if you're facing any kind of issue, you can be letting me know. And further, the full course is available on our website and application. Simply do WhatsApp CAIIB to the number 83609 if you want to get the PDF files. The one-liner PDFs are also available for all the 4 modules and for all the 5 papers of the CAIIB. Make sure to download the application right now from this particular link. And if you are iOS user, use this ORG code, that is an organization code that you need to enter over there. So that's all for today video, and we are conducting the videos 5 days a week from Monday to Saturday except Thursday, right? So there is no video on Thursday except Thursday. We are having 5 classes in a week at the same time in the evening, 9:15 p.m. So hope that you would have liked the video. Thank you so much and see you again in the next video.